Okay, hi guys. This is Frasers Centrepoint Trust financial results for second half and financial year ended 30th September 2025, dated 23rd October 2025. Right, we'll head in straight away. They have already acquired North Point City South Wing, right, and DPU has grown, although actually it's very marginal. Right, they've divested Yishun 10 retail podium, which is about 34.5 million. All right, this is quite small as opposed to its portfolio size so I won't worry too much about this. Their smallest mall is $200 million, then it goes up to $400 million. So, and some of their malls are in billions. So 34.5 million is not a lot of money lah. Okay, successful secondary market fundraising to buy the North Point City South Wing. So they have equity raising of 421 million and $200 million issued of perpetual securities, right? This is something I'm not super fond of, but I think it's a small thing in comparison to what generally they have done well. Okay, cost of debt reduced to 3.5% in fourth quarter, and aggregate leverage lowered to 39.6. Although this is not the real gearing because if you include the $200 million of perpetual securities, I suspect their gearing is more like 41-42%. Right, the rest I won't talk too much about Hougang leasing pre-commitment over 80%, even though that it will only finish sometime in 2026. All right, and I think second half of the year. Right, DPU is slightly up. I think this is like 0.6% up. Right, so not much to get excited about Leverage, again, this is deceptive, does not include PERP, so I won't look at this. Cost of debt down. All right, this is a positive. Right, clearly NAV has gone down to this, but do note that at the time of your watching, I believe that it's already been paid out. The dividends has been paid out, so this is slightly lower. This is not the current NAV. Right, yeah, so there's a slight dip because of this Cathay Cineplex, but I think this one not a big concern for me. All right, we look at other things. All right, year-on-year shopper traffic and sales. Traffic, yep, you see only 1.5%, but sales is up 3.9%, right? So still positive, right? And generally similar to the overall year Okay, again, I think I mentioned in the last half review that this is much better than CICT's suburban portfolio. Remember that FCT is a pure suburban portfolio, right? So this is actually very good results if you compare with CICT, which I believe is negative, right? So rental regions, yes, right? And this is the reason, this is the main reason why I like FCT so much, right? If you imagine FY26 is around 7%, let's not be too greedy Okay, I will expect that DPU might be able to go up something close to 7%, right? Even if, let's say, operating costs increase, right? Is it possible for DPU to go up by 5%? I think it's not outside the realms of possibility right? So then this is one of the reasons why I like FCT, right? It's actually this metric over here. Okay, Hougang AI, not much to say already talked about it. Yeah, this type of things I won't talk about. I don't think it's super important anymore. We've talked about it before. Yeah, all these things we talked about before. Alright, so financial performance generally is flattish It's not say very good. Okay, revenue is up primarily because of the acquisition, right? Cost is up again a little bit higher than we like it to see right? 20%, even though revenue is only up 14%. So NPI is down, up by only 12%, right? This one is marginal, don't have to worry, right? You can see the reason why the distribution is to unit holders is up 12.5%, but our DPU really only increased by 0.6%. It's because of dilution, right? This is not surprising because they actually issued money so issuing money means they have to sell shares right? So this is the equity fundraising part This is not surprising, right? So nothing too much to worry about there. Okay, so yeah, where was I? Sorry. Yeah, I think it's expected Right, so what was I saying? Yes, oh yeah, I was saying this part. Right, so if we look at this, this one already discussed the dilution is expected. This is the full year DPU, right? First half, the improvement was 0.5%. Full year is 0.6%. Okay, let's look at today's valuation. All right, recently the price dropped. Okay, of course dropped due to XD is expected, but they dropped further even after XD, if I believe correct. If I remember correctly lah, I look at the chart for this week. Currently the price as of end of Friday is $2.28. Right, based on this DPU is 5.31%. Right, in my opinion, this is not bad. Okay, primarily because of the fact that I expect DPU to grow stably next year, because like I said, if the rental can go up by 7+%, right, let's say the operating costs also go up by more than the rental lah, the increase in revenue rather, and therefore your DPU increase by less, but I still expect about 5% increase right, in DPU next year. That's my expectation, right, and that's what I am buying into when I'm buying at this point. Right, so this is my personal decision. All right, I'm not giving any financial advice here, right, but I'm also not buying a big position because I already have quite a sizable percentage in FCT. I think 4% of my portfolio, which is quite high because I kept each stock in my portfolio at 5%. All right, so I'm a very conservative type of investor. So just to let you know that I'm buying a bit at this price lah. Okay, but again, not financial advice. No financial advice is ever given on this channel lah. Okay, the current NAV is $2.17, but at this point I won't look at NAV. Right, we are like moving into a lower interest rate environment. I don't think it will be as good as the post subprime crisis 10 years. That means 2010 to 2020 maybe. Yeah, but I think valuations could get better because of the low interest rate environment. At least in Singapore, interest rate is very bad, right? At this point, I think less than 1.5% if you look at any risk-free Singapore government bonds, right? And therefore 5.3% for REIT that I expect growth and the properties are very stable. I think it's a very enticing opportunity for me. Again, only for myself. None of it is financial advice. Right, remember this leverage here is a bit deceptive because it doesn't include the $200 million of perpetuals, right? And I'm not super happy with the perpetuals. Cost of debt is like almost 4% right? At this point, I feel like you can get cheaper debt, but I'm not sure if I'm not sure why they got such expensive debt, but I guess they just wanted to finish the deal and move on right? So in general, you can see quarter cost of debt is dropping, right? Generally a positive thing, and hopefully this will help also in mitigating the cost associated with running the REIT next year Hopefully this drips down to DPU. Right, I don't think I have too much more to say. The rest are already mentioned, right? I don't think there's anything here to worry about. Right, this one is due to the Cathay exit. Alright, so I'm not super duper worried about it. Central Plaza a little bit low in occupancy right? These two are because of the exit Alright, so that one can't be helped. It may cause a slight drop in revenue in the near term. Alright, I'm not sure if they worked out this issue already. Alright, so this is a slight negative for the REIT, but I think it's a short-term thing, so I'm not too concerned about it. Right, yeah, I think that's roughly it. I don't really have too much more to share. Okay, yeah. Alright, with that, I'll end the presentation. Thank you for listening.